All right. Today is Monday, January 10th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, but it's going to be a long one with a lot of graphs and a lot of charts. And some of you would say, hey, slow it down. This is too much for me. ADHD, I cannot concentrate. I have to watch the videos twice now. Lots of charts, lots of graphs. And I say, you know what? This is the lion's den. This is the big league. You want to be with us? You better have a bigger stomach. Otherwise, go back and play with your friggin' Legos. But for the rest of you, here it is. In focus tonight. The bubble is imploding. And we're just getting started here. Although, here's the good news. We have a relief rally coming. We're going to start with the bad news. Then I will serve you the good news. Remember this video that I produced before the end of the year where we discussed the Buffett indicator and I discussed my theory on why the market bubble will crash in 2022? Because the Buffett indicator has reached an extreme level, reading over 200%. And of course, the greatest investor of all time, Warren Buffett, said, when his indicator reaches these readings and you are still long the market, you are playing with fire. Because every single time the Buffett indicator reaches these extreme readings, we get a market crash. But I also told you, there is one condition that has to happen before the Buffett indicator plays out. And this condition is the rise in the 10-year yield. Interest rates moving higher. Well, guess what? So far this year, interest rates, specifically on the 10-year yield, are moving higher. And therefore, you're seeing the market pulling back dramatically. And this was the only missing ingredient that the Buffett indicator needed for the market crash to start. The headline reads, U.S. Treasuries off to worst ever start of the year. Once again, the performance of bonds at the start of the year is the worst in history. We're seeing a massive sell-off in bonds here. And as you can see in white, this is the expectations for the Fed funds rate, meaning the expectations whether the Fed is going to raise interest rates or drop them. As you can see, this line is rising higher, meaning expectations for higher interest rates are taking place. That is coming hand in hand with a drop in the line in aqua, which represents U.S. Treasuries. Bond prices, they're going down as the expectations that the Fed is going to raise interest rates continue to move higher. And when bond prices go down, yields pop higher. U.S. Treasury yields rise as wage growth backs bets on March Fed hike. The latest jobs report, the icy hot jobs report, was a disaster for the Fed and Jerome Powell because, yes, the headline reading is down, 199,000 jobs created in December, but the unemployment rate is down below 4% and wage inflation continues to move higher. And therefore, the expectations that the Fed is going to jack interest rates are surging higher and higher and higher. And this is pushing yields across the yield curve also higher and higher and higher. Matter of fact, the pop in the 5-year yield is historic. The third biggest pop in history. And by the way, just give it a few days and we might surpass the record from 2003. Look at what happened in 2003 and 1982. Not good years for the stock market. And even the 10-year yield, well, hello. Real rates jumped by the most since March of 2020. Now, what is the result from this dynamic? Bond yields surging higher, bond prices going down, the expectations for Fed tightening is surging higher. What does that do to the stock market? Here it is. Surging bond rates threaten to muzzle dip buying stock bulls. You know, the blindfolds on, running Naruto style, heads first, asking questions later, buying the dip every single time. Well, now you're catching a falling knife. And yes, I am predicting that we're going to have a relief rally, but that's all there is. If you think that this is the dip, the bottom, and you should go all in buying stocks again, you're gonna catch a falling knife. This dynamic of surging bond yields and higher expectations of Fed tightening is producing massive pain across many pockets in the stock market, specifically the high multiple names. Take, for example, Revlon, the IPO mania. Revlon lost over $75 billion from the top. Matter of fact, accounting for today's losses, make that over $85 billion. Wiped out. The biggest scam I've seen in history is the IPO of Revlon, pushing a company with no product to surpass the valuation of General Motors and Ford. Absolute insanity. So Revlon is getting a nice haircut. What else? How about ARK Innovation? For Tesla witch Kathy Wood, nice haircut. An unprofitable tech, also nice haircut, but look at what's going on in yellow. The fangs, the big guys, they're still holding. But rest assured, they're gonna get shot next. This is how bubbles implode. You start shooting the small caps, the high multiple high mania names, and then you shoot the mid caps. Then the large caps come down crashing. Here's another illustration for you. As you can see, ARK Invest in Aqua, nice haircut here, big one. Matter of fact, ARK Invest is bald right now. You gotta wait for the hair to grow before you give it another haircut. But look at what else getting a haircut. IPOs in yellow down big, and in white, profitless tech. The geniuses thought it's a great idea to buy profitless tech. Well, look at what's going on now. We also have in pink SPACs. They're also imploding, getting a nice haircut. And the pain in Mama Kathy's ETFs are becoming headline news now. Kathy Wood, ARK sees near record short bets in tech wreck. The shorts are piling in. The bears are striking Mama Kathy left and right with no mercy whatsoever. The bets against RKK are reaching pretty much all-time highs. Now, is it too late to short RKK? I don't think so, because I believe that RKK and Kathy Wood will go down to zero. And I shorted RKK last year in January. I was a little early, but you're better off shorting a little early than too late. And I said this in February 24th, 2021. If you are investing with ARK, you are pretty much handing your cash to Kathy Wood, who'll blow it in the casino. History will repeat itself. Google what happened to the hottest .com funds in the aftermath of 2000. Names like Putnam Emerging Growth Fund and Munder Net Fund, also known as Murder after the crash. And a lot of you said, bro, you don't know what you're talking about. You're just jealous of Kathy Wood. She got more money than you do. Okay, that's no problem. But for you shorts who want to short ARK Invest, understand this. It is already in bear market territory. What does that mean? You're gonna see bear market rallies, and these are notorious. They can produce 10, 20, even 30% pops. So be ready for that and short in increments. You short some today, it pops higher again, you fade the rip, you place another short, etc., etc. Until, of course, Kathy Wood repents, keyword repents, and drop the whole thing about my piece of shit companies that don't even produce revenues or profits, gonna disrupt and destroy and take everything over. All fantasies that are not gonna happen. And even if they do, the valuation's out of whack. The whole point of investing, after all, is to buy cheap and to sell expensive. Not to buy expensive hoping that you're going to sell at a more expensive price. That kind of stupidity works in bubbles when the Fed is loose, not when the Fed is tightening. And here it is, insiders of ARK Invest are actually dumping. They're selling, they're not buying. What else getting a haircut? How about biotech, high multiple names, the worst week since early days of the pandemic. Last week was the worst week for biotech stocks since the beginning of the pandemic. How about TAN, the solar mania? That's coming down crashing too with a nice haircut. The TAN ETF lost $70 million on Thursday alone. Unbelievable. Here's another one. Tulips, cryptos, they're also getting a nice haircut. Bitcoin, Ether, all of them coming down crashing as interest rates move higher. Matter of fact, the Bitcoin ETF goes from boom to bust. So that's a nice trash bag right there. Another one. How about the fintech mania? That's getting a nice haircut. But fintech is the future, bro. The valuations don't matter. Yes, they do. Here's the evidence. They're dropping like a rock. How about Chinese stocks? The high-tech Chinese stocks. A very nice haircut right here. You had the head and shoulder formation. It is playing down. Now you have a bear flag that is playing down. And who knows where the pain is going to stop. How about the most shorted stocks? You know, the apes, the Robin Hoodites and the likes. They don't invest in profitable companies, high revenue companies, high growth companies, companies with solid cash flow, good dividend. That is boomer kind of investment, bro. We don't do that. We buy the shittiest companies, the companies with the highest short interest, because we're hoping for a short squeeze. They taught these morons that stocks can pop higher on a short squeeze. Yes, they do, but the main attributor to the mania in GameStop and AMC is the stampede, not the short covering, baby. I've been shorting stocks since I was 18 years old. You cannot produce this kind of mania on a short squeeze. I've never been squeezed in any short position in my entire trading career. Never happened. So whoever tells you that, oh, the holy short squeeze is going to happen, you got to buy the shittiest companies in the world. They're lying to you. Most of these guys didn't even finish college to begin with. And here it is. The most shorted stocks, they surged higher during the so-called meme stock mania, but they're now coming down crashing, and you haven't seen anything yet. Matter of fact, the whole Tina argument, that is getting a nice haircut because the NASDAQ 100's earnings yield fell to the lowest relative yield to bonds in years. So even the Tina argument is getting shot and getting a nice haircut. When the Fed is tightening, you have few pockets left to hide in. Even commodities are getting shot. Take a look at palladium, for example, getting a nice haircut here. But the good news for commodities, so long as the Fed remains quote-unquote accommodative and they're not raising interest rates yet, you're going to see the dips being bought in commodities and they're going to move higher again. Case in point, lumber, soybeans, meats, they're all moving higher again. So what is working here in this environment? When the Fed is tightening, interest rates are moving higher, what works? No haircuts here. Take, for example, the KBW Bank Index, which had an incredibly strong week relative to the NASDAQ 100, and this is the best performance in 2 decades. Once again, unbelievable, but it's happening. Matter of fact, we're seeing billions of dollars. The latest number I looked at is over $3 billion so far this year, so far, being poured to buy banks and bank ETFs, the likes of the XLF and the KRE. Why? Because when bond yields move higher, banks do pretty good. But that depends on a steeper yield curve. What do I mean by that? Let's say the shorter end of the yield curve, we're talking all the way to the 2-year, let's say the 5-year. If that moves higher at a faster pace than the 10-year to the 30-year end of the curve, then that's not going to be good for banks, because banks rely on a steeper yield curve. They borrow on a lower interest rates and then they lend that money to you at a higher interest rate. And this is the whole banking business in a nutshell. That is what it's supposed to do, not under the criminal tyranny of quantitative easing, where banks relied on charging you and I, the consumer, late fees, maintenance fees, deposit requirements, and all that garbage of just juicing cash from the consumer. They're supposed to make money from lending, not from criminal activities. What else that is working under this dynamic? How about value? Value is surging higher for the first time in forever. Value surges. When you pin it against the NASDAQ and the high multiple names, value is outperforming tremendously. And now value is matching the pop that we got earlier last year. Now that could be a good point for a pullback in value stocks, but if the dynamic remains the same, meaning the Fed is tightening, becoming hawkish, interest rate expectations are moving higher, then the dip in value will be bought again, and any rip in growth and technology will not last for too long, and it will be faded right away. When we talk about value, what do we mean by value? Do I look at price to sales ratio? How about PE ratios? How about PIG ratios? How about price to book ratios? There are many styles in identifying value stocks. But think about it like this. Stocks that produce excellent cash flow in the present right now, not the future, bro. Good revenue growth, good net income growth, good profitability ratios, yet the multiples are down. Be it price to sales, price to earnings, doesn't matter to me. Any stock that fits this description is value to me, but you gotta be careful. Take, for example, Morgan Stanley. Morgan Stanley says, if you want to look for value stocks, look at Europe, because European stocks are value when you pin it against our hyper bubble mania US stocks. That is true on paper, but you have to factor in the synchrony between markets. What does that mean? It means European stocks have been moving higher as US stocks have also been moving higher. Yes, trailing the performance of American stocks, that doesn't mean that European stocks are value, because I promise you, when the Dow Jones, the S&P 500, and the NASDAQ start to fall apart, you will see European indices also falling apart. Once again, when America sneezes, the whole world will catch AIDS. So I disagree with Morgan Stanley on this call. How about Facebook? Yes, it is value. Facebook is one of the best value stocks out there. Good PE ratio, good growth, good profits, good cash flow, good price to sales ratio. When you pin it against Microsoft, Apple, even Alphabet, Facebook is indeed value. But here's the trap. All of these stocks trade in synchrony within ETFs. When investors start to dump the ETFs, Facebook is going to suffer the same pain that Apple, Microsoft, Google, and the rest of them will suffer. So be careful here in picking value. Now, let's talk about the good news for the bulls, the upcoming relief rally. Indicator number one is this. The headline reads, serious money is being put to work as traders position for the strong possibility that the Fed will hike interest rates at the March monetary policy meeting. Is this a problem? Not yet, but here it is. When everybody piles in on one side of the trade, you gotta be careful that something is gonna fire back. Traders are following these calls, putting cash to work in February. Fed funds futures driving an explosion in open interest. The amount of open positions or open interest in the contract now exceeds 200,000 futures as of Friday's close, just north of $1 trillion in notional value. That is the most of all the tenors out to June 2023. The contract expires February 28th, and it is gathering interest because it is the last Fed funds futures that expires before the March 16 Federal Reserve rate decision. So again, they're going all in, shorting the Fed funds, not the rate. They're betting that the rate's going to go higher, so they're shorting the Fed funds contracts futures. Selling in the tenor was again evident in Monday's early New York session, including one trade for a size of 15,588 holding a notional value of $78 billion. Wow. Last week, most of the selling was seen Wednesday and Thursday after front-end swaps repriced a hike at the March meeting to 80% following the December 15th meeting minutes release. So we now have an 80% chance that the Fed will start raising interest rates by March. As of 10 a.m. New York time, a March rate hike is priced at 86% chance. This is today, the betting odds. Despite the recent selling flurry, there still appears more downside room in the February Fed funds futures should March lift-off conviction grow. Again, how high are we going to go here? 100% chance? Could be. But this kind of stampede always opens the possibility that things could fire back. For example, what was the driver for the Fed funds rate expectations to move higher? The answer is inflation. Inflation is out of whack, the Fed has to respond, and therefore the expectations of higher Fed funds rates are moving higher and higher and higher. What if I told you that the CPI reading we're about to get is going to be served a little cold, a little cooler than our expectations? The cooks are going to work a little harder. You know, the cooks at the Bureau of Labor Statistics? Well, they screwed up last Friday when they gave us the jobs report. The headline number was cooked. They forgot to cook the unemployment rate and the average hourly earning inflation. The cooks want to make a comeback here. What if the cooks show us that the CPI is actually declining month over month? Forget about year over year. We already know that the CPI is going to be hotter year over year. But what about month over month? If that reading is cooling down because energy prices went down in December, then all of these shorts will get caught with their pants down as we reprice. Perhaps the Fed is not going to raise interest rates by March, maybe by June now. See what I'm saying? That will pull down rates, and this could produce a massive relief rally in the garbage stocks that I just shared with you. The RKK, the profitless tech, the most shorted stocks, the NASDAQ, the high-tech, high-money names, yada, yada, yada. Morgan Stanley says the rout in expensive tech is almost over. Okay? Goldman Sachs sees new conundrum capping Treasury yield surge. Conundrum is a good spice, by the way. What are they talking about here? Yes, yields are popping higher. That doesn't mean that there is no resistance. The path to climb is really hard. Really steep. You're not going to make it all the way in one shot. There will be stops. There will be pullbacks in the surge of the 10-year yield, and that will produce a relief rally in tech. As we head to the CPI, what is the forecast? The forecast is inflation will move higher. But once again, what if I told you that the month-over-month reading will come down? That is a possibility. But we have synchrony across the globe. Every central bank is being hawkish. Even in South Korea, they're also expected to hike rates this week. So the consensus is, yes, the Fed will raise interest rates. The question is it going to be March, June, July, September? That will make the difference. You know my stance. I think the Fed is way behind the curve. The Fed should have raised interest rates last year. So I am in the camp that the Fed should raise interest rates by March. Will they do that or not? That's another question. Here's my indicator, and this is from Gas Buddy. The average gas price that you and I, the consumer, are paying As you can see, the average price is off the peak. It traded down in December. It is recovering so far, and you and I know that inflation is not transitory. So long as the Fed is not raising interest rates, these gasoline prices will recover the peak and then some. But in the meantime, the drop in gasoline prices will produce a lower CPI month over month, because energy is a huge component of the CPI. So absent of a substitute, meaning a surprise surge in meat prices or rent prices or any other component beside energy in the CPI, the assumption is the month-over-month reading will be slightly down. And this is my thesis for the relief rally in tech. Other people who bought the dip today say, oh, Powell, when Powell testifies tomorrow, he's going to be more dovish. I doubt it. If anything, he's going to be more hawkish now to convince Congress that inflation will be under control. My only thesis is a lower CPI reading month over month. Now, if we get a hotter CPI reading month over month, then we're not just going to cue Elmo with the fire. We're going to cue the nuclear bomb. Here's a chart for the 10-year yield. What did we get today? A reversal candle. It awaits a confirmation, but as the 10-year yield showed a reversal candle, that excited dip buying in the Nasdaq and across other indices. When we talk about inflation, by the way, which is the main driver for interest rate expectations to move higher, which is producing the rout that you're seeing in the stock market right now, we have many outlooks here. Take, for example, inflation expectations in Argentina, which is facing one of the most insane inflations worldwide, over 50% inflation in the country of Argentina. The outlook for inflation was to cool and to trend down, according to the November survey. Well, guess what? The December survey is now predicting that inflation in Argentina has a little more room to go before peaking. On the other hand, here is the outlook for inflation in Brazil. They're already predicting that inflation has peaked in that country and inflation will come down crashing. Which outlook do we believe? Argentina or Brazil? It doesn't matter to me, because at the end of the day, you and I know inflation will go down. The question is it going to go down for the good reasons or for the bad ones? Here is Mohammed Al-Arian.
Now inflation is an issue. And John, inflation will come down by the end of 2022. The big issue is how it comes down, not whether it's going to come down. It will come down, but how will it come down? Will it come down in an orderly fashion? Or it'll come down because the Fed is forced to over-tighten. That's the issue that's facing the market. But whichever way you look at it, the Fed has more difficulties doing a U-turn this time around because of what's happening to the inflation dynamic.
Lastly, any relief rally we get will be transitory, meaning an opportunity to fade the rip. So long as this dynamic of a hawkish Fed, higher inflation, higher interest rates expectations, and higher bond yields continues to be with us. And for now, looking at commodities prices, the assumption is inflation will spike higher again. And the dip in inflation, if it happens, will be transitory. What does that mean? The relief rally in tech stocks will also be transitory. If we look at the technicals, the sentiment indicators, in blue, the NASDAQ composite, in red, the average recommended stock market exposure among short-term NASDAQ-focused stock market timers. This is a reliable indicator, by the way. What you want to see is that red line to read -20, -40, -60. Then you know we have extreme fear in the market. Everybody's bearish. We're not seeing this right now, so we have more pain to come. Any relief rally we get will last for a little while before the pain resumes. You need to see extreme pain, extreme fear before the market bottoms. And what we're having right now is not extreme fear. Anyhow, folks, with that out of the way, we have a lot to cover here. And let's start with the market performance. And here we go. The Dow Industrial Average closing in the red, down by 162.79 points, or a decline of 0.45%. The Nasdaq, the comeback kid, closing in the green by 6.93 points, or a gain of 0.05%. Way off the lows. The S&P 500, similar story here. Not quite in the green. It's in the red, down 6.74 points, or a decline of 0.14%, well above the lows. And here is the sector's performance today, leading the pack at number 1, capturing the gold medal, healthcare. At number 2 for the silver, technology. Number 3 for the bronze, communication services. On the other hand, the last laggards of the day led by industrials, cyclicals, and utilities. What about the advance to decline ratios? NYSE 26% advancing versus 71% declining. The NASDAQ 27% advancing versus 70% declining. Now, pretty much every time we have exaggerated ratios to the downside, we see a rebound in the following day. Not always, but it often happens. Moving on to commodities, futures, what's going on here? Energy, we have massive gains for natural gas, climbing higher by over 5.5% today. Gonna cover news about natural gas in a minute. Yet we have losses for crude oil futures, be it the WTI or Brent, both closing the day in the downside. What about softs? Muted activities for cotton, OJ, cocoa, all pretty much in the flat line, while we have losses led by lumber, coffee, and sugar. A lot of pain for sugar as of late. What about metals? Modest gains for silver and gold, while we have losses of almost 2% for platinum, followed by copper and palladium. What about meats? We talked about meats. We're going to talk about meats again. But so far today, we have modest losses here for feeder live cattle futures. On the other hand, lean hogs futures losing over 1.5% today. Lastly, what about grains? Not a good day for grains either. The only gainer is wheat by almost 0.5 percentage point. Yet we have losses across the board led by soybean meal, soybean oil, rough rice, corn, oats, canola futures, all closing in the red today. And here are some commodities news for you related to natural gas popping higher today. And the reason is the deep freeze we're about to get in the Northeast. In New York, for example, temperatures are dropping down dramatically. If you're in New York, you're going to freeze your nut tonight all the way till tomorrow, and then it's going to warm up a little bit. We'll look at Chicago. You're already freezing your nut right now, but hey, what's new? It's Chicago. How about Boston? Temperatures are dropping, but they will drop down dramatically overnight, all the way till tomorrow, and therefore natural gas prices are moving higher. Another front we're watching in natural gas is the talks between the US and Russia. So far so good, but it's not fruitful. The Russian side said the talks were professional, but no agreement so far. This is really interesting because if the talks fall apart, you and I know Russia will invade Ukraine, and then Europe will be caught in the middle of the conflict between the US and Russia. The Europeans, specifically the Germans, they're not so hot about battling Russia. They want to do a business deal here. It makes sense for them to buy cheap Russian natural gas. We are the problem here. We are saying to the Germans, don't do it because you're going to give Russia more influence over the European Union. So it is really interesting how this situation will unfold. Could we see a point where the European allies are going to say, you know what, enough is enough. Enough with the hostilities with Russia. It is not worth another war. It is not worth it to lose Ukraine. Give the guy whatever he wants. Give us whatever we want. And mind your own business. We'll see. We're also watching iron prices. They continue to move higher, rebounding from the lows. We have more bullish news for iron. Vale, the world's second largest iron producer, halted some mine production because of heavy rainfall in the state of whatever that is. I forgot how to pronounce it. Not up on my Portuguese. And as you can see from the chart, iron prices have been moving higher. This is a weekly chart. Off the lows, matter of fact, it was a great buying opportunity back in December. Iron prices moved from about 90 to over 125. We're now facing the resistance of the Fibonacci level. That doesn't mean that the rally is over in iron. How about beef? Beef prices also moving higher. We know that there is a problem. The administration is trying to crack down on beef prices because when we talk about gasoline prices, some of us are not working. We're working from home. We're not transporting, and therefore it is not impacting us directly. But what is impacting all of us, the majority of Americans happen to be meat eaters, is meat prices. The Biden administration is really concerned that they're going to head into the election season with meat prices skyrocketing. And guess what? They are moving higher. Bad news for Joe Biden. For many reasons, of course. Sooner or later, with the inflationary environment, every commodity will move higher again. But we have more specific news that impacted beef prices higher. The headline reads, ground beef sold at Walmart, Kroger, Albertsons recalled for possible E. coli contamination. More than 28,000 pounds of ground beef, including packages sold at some Walmart stores, are being recalled for possible E. coli contamination. So if you didn't know, now you know. Moving on To the big casino, the options market. What's going on here? The hottest table by far remains Apple with almost 1.4 million contracts traded today. About 65% of those were calls. And at number 2, Tesla, the souffle, with almost 800,000 contracts. About 57% of those were calls. And here it is at number 3, AMD, with almost 500,000 contracts traded today. About 57% of those were calls. I also like to look at the implied volatility, specifically the IV percentage. Now, this is not an indicator to buy or sell, but usually when we have elevated IV percentage reading, it means that the primary move is about to reverse. Meaning, you have a stock at a 96 IV percentage. It has been moving higher. Prepare for the stock to pull back. On the other hand, if the stock has been getting hammered and the implied volatility is surging higher at a whack, prepare for an upcoming bottom. But the real take is, when the implied volatility surges higher, the risk versus reward is not worth it anymore, because options premiums move higher hand in hand with the implied volatility. When you look at this table, for example, let's say we have an upcoming pop in the stock market, specifically the high-tech, high-multiple kind of names. Are you going to buy call options for AMD with 96% IV percentage, meaning the current implied volatility is higher than 96% of all occurrences in the last year? Or are you going to buy call options in something like AMC with only 28% the IV percentage, meaning these options could appreciate dramatically in value if the implied volatility in AMC surges higher? There is more room for the implied volatility in AMC as an example here to move higher versus AMD, which is already at 96%. And here are the unusual activities that took place in the options market today, starting with the ticker LVS for Las Vegas Sands. They're betting on a rebound here, a big one, by buying the 43 calls for the expiration date March 18th, with expectations that the name could pop higher by more than 18% by then. They paid about 90 cents apiece to enter this trade, all in all spending about $1.3 million. What about the ticker mRNA for Moderna? Popping higher today, and they're betting for more gains to come by buying the 250 calls with the expiration date January 14th, meaning this upcoming Friday, with expectations that Moderna can add an additional 7.5% or more by then. They paid about $3 a piece to enter this trade, all in all spending about $4 million. What about the trade for the ticker NKE Nike? They're buying the dip here, the 160 calls for the expiration date February 11th, with expectations the name could pop higher by more than 7% by then. They paid about $1.25 a piece to enter this trade, all in all spending about $1 million. What about the ticker ROKU? Roku. They're buying puts, betting for more downside to come by buying the 170 puts for the expiration date January 14th, meaning this upcoming Friday, with expectations that the name could drop down by more than 6.5% by then. They paid all about $2.25 a piece, all in all spending about $2.5 million. And here it is, the ticker AMC for, you guessed it, AMC. And I followed this trade, by the way. They're buying the 25 calls for the expiration date January 14th, with the expectations that AMC could pop higher by more than 11% by then. They paid about 55 cents a piece to enter this trade, all in all spending about $400,000. And all of that came from my pocket alone. Just kidding. But here it is at the bottom of the table. What about the ticker PLTR, Palantir? The buying puts here, betting for more downside to come. And by the way, what about the Palantir scam artists, the pumpers on YouTube? Palantir is going to the moon. The rally is about to start. Now you know. But anyhow, somebody's buying the 14 puts for the expiration date March 18th, with expectations the name could drop down by more than 14.5% by then. They paid about 80 cents a piece to enter this trade, all in all spending about $550,000. What about the trade for the ticker ARKK for Tesla witch Cathie Wood? ARK Invest. I followed this trade, by the way, even though I'm short RKK, so I'm betting on a relief rally in the name. They bought the 90 calls, or shall we say, we bought the 90 calls for the expiration date February 18th, with expectations that the name could drop down. It might drop down, I'm not sure. But the bet is that the name could pop higher by more than 7% by then. And we paid about $3.20 a piece to enter this trade, all in all spending about $2 million. What about the trades for the ticker IWP? This is the mid-cap growth ETF for the Russell 2000. It's a put spread, really intelligent spread here. they're buying the 100 puts and they're selling the 90 puts for the expiration date February 18th, with expectations that the IWP could drop down by more than 5.5% by then, but not more than 15%. They paid about $1.55 apiece for buying the 100 puts, and they received about 55 cents from selling the 90 puts. All in all, reducing the entry cost to about $1 apiece and spending $600,000 for this trade. The risk versus reward is really good here. They can flip $1 into 10, so that $660,000 could end up being $6.6 million by the end of this trade. More unusual activities for you. What about the ticker GDRX for Good RX? I played this name last year. It was a nice trade, producing over 60% gains, and then the name fell apart. But here's somebody betting on a rebound by buying the 27.5 calls for the expiration date, January 21st. And this trade is already in the money, so the expectations are the Good RX will close above 27.5, but specifically above 29. Because above 29, it means gains. Closing below 29, it means you're going to lose on the trade because they paid about $1.50 apiece to enter this trade, all in all spending about $1.4 million. Another in-the-money trade for TSLA Tesla. They bought the 1,020 calls for the expiration date this upcoming Friday, January 14th, with expectations that the souffle will close the week above 1,075 for this trade to be profitable because they paid about 55 cents apiece, $55 apiece to enter this trade, all in all spending about $82 million. A lot of trust fund babies are playing this game. What about the ticker AMZN, Amazon? They bought the 3,250 calls for the expiration date this upcoming Friday, January 14th, with expectations that Amazon will close the week above $3,280 because they paid about $30 apiece to enter this trade, all in all spending about $21 million. And lastly, at the bottom of the table, what about the ticker AAPL for Apple? Another in-the-money trade. They bought the 170 calls for the expiration date February 11th, with the expectations that Apple will close by the expiration date above 178 for this trade to be profitable. And the reason is they paid about $7.50 apiece to enter this trade, all in all spending about $5.5 million. Moving on to the heat map analysis. What's going on here? You're seeing the opposite picture of last week. We're seeing banks, oil, industrials, materials, defensives pulling back. Even the reopening names are pulling back. What's working? The laggards of last week. Healthcare, the high multiple names in software, technology, chips, Tesla, all moving higher. So is this the start of something? It will be if interest rates, specifically the 10-year yield, cools down. But it won't be if we see the 10-year popping higher again. Be careful of placing all your bets on Jerome Powell's testimony tomorrow. You could actually be more hawkish than we heard before. Place your bets on a cooler CPI reading if you're betting that technology will rebound higher. Today was an ugly day for the reopening names, specifically retail. Even Lululemon went down big. And the reason is the shutdowns, the shortage of staff from the Pokemon variant. Now, what about the heat map for the ETFs in the market? Again, you're not seeing oil, XOP, XLE, you're not seeing materials and financials, XLF, KRE outperforming. They're actually trading down. What's working this time around? The losers of last week. Chips, SOXL, Biotech, the IBB, XPI, Healthcare, XLV. And again, notice the contrast between value and growth, pretty much neck to neck, flat. Value is not outperforming growth, but if the 10-year yield pulls back and we have a confirmation tomorrow, you will see growth outperforming value, and hence the relief rally. Moving on to charts, starting with SPY, 30 minutes chart. What's going on here? Gapping down in the morning, ugly. Absolutely ugly in the morning. It didn't even catch the support of 461, but it did catch 456.5. And look at the symmetry. I'm highlighting the symmetry. The SPY also rebounded higher from that level before in December. Now, let's zoom in a 15 minutes chart. What do we see here? A rebound from around 456.5, creating a series of higher lows and closing at the highs of the day. Is this bullish or bearish? The answer is it is bullish. Now, the SPY did not close the gap. We're not going to make a big deal out of it because perhaps we ran out of time. So in tomorrow's opening, we're awaiting closing the gap and perhaps reclaiming 466.5 as support once again. Here's a daily chart for the futures contract for the S&P 500. Look at this massive candle. Is this candle bullish or bearish? The answer is it is bullish. A massive rebound higher. You cannot fight it on a higher than average volume. Yes, the momentum indicators are negative. The bears are still in charge, but we are trading above the bull to bear advantage line of 4,657. What does that mean? It means that the bulls are closing in. They're fighting back here. The bears shouldn't be too greedy. If you see the 10-year dropping down, you buy calls on growth in the NASDAQ, and then that rebound will stop and we will have another shorting opportunity. What about the Qs? 30 minutes chart. What's going on here? A nasty gap down in the morning, violating the support of 372, but rebounding from 369, really close to that number. And again, the NASDAQ closed at the highs of the day. It managed to close the gap and it recaptured 379 for support. Again, is this bullish or bearish? It is bullish. The problem for the NASDAQ, look at the gap between 379, which is support now, and the next resistance, 397. There isn't a lot of support/resistance between the two numbers, and therefore, when the NASDAQ's chart violated 397 as support, it produced a nasty flush down due to the lack of support. So again, if we're going to move higher, on the way down, there was no support. On the way up, we're going to have little resistance. So keep that in mind. And here's the daily chart for the the futures contract for the NASDAQ. Again, an excellent candle, a reversal candle, massive hammer. Is this bullish or bearish? It is bullish, with higher than average volume, recapturing 15,500. All of these are points for the bulls. The bears have the momentum indicators. They remain negative, but the bulls are closing in here. The message for the bears, don't be too greedy. Trade accordingly. Your guide is the 10-year yield and the VIX. In this case, the VXN for the NASDAQ. And what about the IWM 30 minutes chart for the Russell 2000? What's going on here? A gap down, closing the gap at 213 and rebounding almost from 211 and closing at the highs of the day, yet not closing the gap from the morning. We're not going to make a big deal out of it because perhaps we ran out of time. But is the behavior that we got in the IWM bullish or bearish? The answer is it is bullish. And if the bullishness continues, then we're looking up for 218. That would be good resistance right there. But I doubt that the Russell 2000 will make it all the way to 218 and capture that as support easily. Moving on to the daily chart for the dollar index, the Dixie. What's going on here? We lost the support of 96, but this is not producing a flush down. And therefore, we have to wait for tricky Dixie. Because you can look at the chart, and the first thing your eyes are going to catch is what if this is a massive bull flag consolidation, meaning that the dollar could pop higher. You can entertain that thought for a long-term perspective, but in the short horizon, it will all depend on Jerome Powell's testimony tomorrow. If he comes out too hawkish, then guess what? The dollar will pop higher again. Perhaps it will reclaim 96 as support. If not, we will see a flush down in the dollar, and this will be good for commodities, specifically the old man, gold. Here's a daily chart for gold, rebounding off the lows, closing at the highs of the day, even though the dollar was up, and most importantly, the 10-year yield also traded higher, all the way up to 1.8%. Here's something to think about. On your left-hand side, the 10-year TIPS yield, which is a proxy for the 10-year yield. On your right-hand side, is the performance of gold. Now on top, the performance all the way to the end of 2021. As you can see, when the yield on the 10-year TIPS went down, gold rallied higher, and then we saw consolidation in both. Now, on the bottom, the performance, including January 2022 so far. We're seeing a massive pop in the yield of the 10-year TIPS, yet gold is not crashing, and this is contrary to expectations. And this is my thesis, by the way, behind being bullish on gold, that the inverse relationship between the 10-year yield and gold will reverse because market participants will realize that gold is indeed a safe haven when the Fed is tightening. And here's the chart for the 10-year yield. We already talked about it, but this appears to be a topping formation. We're awaiting confirmation tomorrow. Don't jump the gun here until we get a confirmation. Now, let's say the 10-year yield pulls back all the way to 1.7. That will be a lousy pullback, meaning a lousy rebound in the Qs, tech, the high multiples, aka a dead cat bounce. Now, let's say we pull down all the way to 1.65%. Now, this will produce a meaningful rebound in tech, the ARK Innovation Club, and the rest. A pullback all the way down to 1.5%, erasing the rally. That's not going to happen unless we have significant news that the economy is slowing down dramatically. I don't see this happening. So my target is pulling back all the way to 1.7, perhaps 1.68, but that's about it. ahead. So the rebound in the NASDAQ, the high multiple names will not be that big, but it will be worthy to play it for a trade. And then we'll take it from there. And here is the weekly chart for the TLT. What's going on here? A good start for the week. Perhaps we're going to retrace some of the losses from last week, and this will come hand in hand with a pullback in the 10-year yield. If that happens, we will see a pop in technology. So you got to watch these indicators. Bonds, the VIX, the dollar, all of these are good indicators to guide your trades. Speaking of, here is the 4 hours chart for the VIX. What's going on here? The bull flag played out, but look at what happened by the end of the day. The VIX lost support at 20. Is this bullish or bearish for the chart of the VIX? The answer is it is bearish, which happens to be bullish for the SPY, the S&P 500. We have yet to have a confirmation this will happen for the MACD indicator. If the MACD on the 4 hours crosses to the negative territory, creating red impressions on the histogram, then you know we have a confirmation the VIX topped, meaning the SPY bottom, at least for now. And here is the 4 hours chart for the VXN, the VIX for the NASDAQ. We have a similar story, a pop higher in the morning, yet losing all of the gains by the end of the day. Is this bullish or bearish for the VXN? It is bearish, which means it is bullish for the Qs, the NASDAQ. But we have yet to have a confirmation, folks. The confirmation will happen from the 4 hours MACD. If it crosses down, creating red impressions on the histogram, you know the deal. What about a daily chart for Apple? What's going on here? Rebounding higher, closing at the highs of the day, did not close the gap at 165.32, and the volume came out higher than the average on the buying side. Is this bullish or bearish? It is bullish behavior. Apple could have easily closed the gap at 165.32. Rebounding before doing that is bullish because it tells us that Apple wants to give it another shot at perhaps reclaiming 172.4 or even the 3 trillion mark before closing that gap below. What about a 30-minute chart for Tesla? What's going on here? Gapping down, catching support from around 995 and closing at the highs of the day. Is this bullish or bearish? It is bullish. And now we're looking for 1,090.5 as the next resistance. Although we have some bad news for Tesla, by the way. They have the new assertive mode in the so-called self-driving option. And here's the description. In this profile, your Model X will have a smaller follow distance, perform more frequent speed lane changes, will not exit passing lanes, and may perform rolling stops. This is a recipe for a disaster. The souffle is endangering all of us, including souffle drivers. Where is the government? Where are the regulators? Why is Tesla getting away with this kind of behavior? Number one, they're experimenting on their drivers like lab rats, and they're putting all of us in danger in the process. Every time I drive and I see a souffle in front, behind, left, right, avoid souffles altogether. And oh, by the way, Tesla's jacking prices higher for the so-called full self-driving mode from $10,000 to $12,000, and this is starting January 17th. This is only for US customers. Now again, is this bullish or bearish for Tesla? It is bullish because Tesla drivers and enthusiasts have no price sensitivity. They will pay more. The problem is, in the long run, it reduces the competitive advantage that Tesla has in the EV market. You're going to compete with GM, Ford, VW, Chinese manufacturers who could underprice Tesla products. Moving on to tulips, what's going on here? We are in a bottoming process. What is a bottoming process? The chart is looking for a bottom. The chart is already oversold. The chart says 42,000, 41,000. The number doesn't matter to me, but that level is good enough for igniting a rally, a rebound higher. In a bottoming process, the chart is looking for buyers. It is consolidating within that range. Any buyers, any buyers, any buyers. If there are no buyers, then the chart will flush down to the next support. If there are buyers, then the chart is ripe and ready to start a rebound higher. So all in all, am I bullish on tulips? The answer is yes, only if the 10-year yield backs off. If you see the 10-year yield moving down, the BTC will move higher. Lastly, what about AMC? What's going on here? This is an hourly chart. We are below the 26 support, now resistance, meaning that the mania is coming to an end. But I will give the apes another shot at it because we have what it appears to be a double bottom at around 21. As you can see, the symmetry is clear for you. We gapped down in the morning, yet the chart closed at the highs of the day. This is bullish behavior. No different than the SPY, the Qs, and the rest of the market today. If the 10-year yield pulls back, I already covered the options for you, the implied volatility in specific, which is really low for AMC, meaning the risk versus reward says if we have a rebound all in all across the market, specifically in the high multiple pockets, then AMC will also rebound higher. Yet AMC call options are really cheap right now. You can flip them really quick. You buy them now, AMC moves higher 5, 6, 7%. These call options will appreciate dramatically. So the risk versus reward says go ahead and buy the dip for now for a trade. So for now, keyword for now, I have joined the apes, but don't get too excited because I will pump and dump right away. In, out, hello, goodbye. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the small business index, which is really important. Then we have a bunch of Fed zombies speaking, Loretta Mister from Cleveland and Esther George from Kansas City, in addition to James Bullard, our favorite, from St. Louis. But the most important zombie speaking tomorrow is the big dog, Jerome Powell. His confirmation, his big day. Let's see what he says tomorrow. All eyes on Papa Jerome tomorrow. And with that, ladies and gentlemen, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.